One very quick story. I was speaking with a nonprofit organization, and the executive director said, "So, Chris, how do we convince people to give us the money they would use to buy their Porsche?" And I said, "Nancy, that's the wrong question. The right question is, how do you convince them to give the money they would use to buy their second Porsche?" And this is the whole point. So your first Porsche or your first whatever is a manifestation and celebration of the value you've created. But you only need one Porsche. You don't need two. And if you decide that you want to give the money away for your second Porsche, you've now made the transition from I made that money for self-aggrandizement versus I made that money for deployment for social good. And so this was about 15 years ago, and she still comes up to me and she says, "I'm still looking for those people who don't want to buy the second Porsche."
Hey Chris, welcome to the show.
Thank you, Bilal. It's a pleasure to be with you.
So listen, we've been speaking for, I think we got introduced like a month or two ago, and we've had a call since then. I've learned all about your background. I've read most of your book. In full transparency, I rarely read a book cover to cover, but I skimmed through it in preparation for
I hope it didn't put you to sleep.
No, not at all. It was really, there's some really interesting concepts in there as well. You're teaching at Princeton, and you've got a new company that you're working on, Rosemark, right now, which we'll go into as well today. But what I was introduced to you as was someone who had sold a company for a large amount of money. So to be specific, $575 million is what was reported. I think you'd confirm that as well. And you'd sold your old company, Rosetta, to Publicis in the agency world. So like before we go into all the details of everything else, I'd love to just kind of hone in into that moment and understand, like take me back to that day. Like what was it like when you were actually going through that sale and you've been working all these years, putting your blood, sweat and tears into it, and you finally get this through over the line?
It is, as you might imagine, a rather miraculous moment. The first day of Rosetta was June 3rd, 1998, and it was May 15th, 2011. So whatever that is, 13 years later, almost to the day. And it was such an honor to be able to build and lead an incredible group of people through the journey from what I like to say was exactly $0 million on June 3rd to a point where someone was willing to write a $575 million check. And so to your question, in some regards, each part of the journey is hard and it feels interminable until you reach the next milestone and look back and realize what a short period of time that was. In fact, one of my fellow entrepreneurs once likened being an entrepreneur to parenthood, and the expression in parenthood that resonates is long days, short years. And I think long days and short years is a great way to describe the journey as we built Rosetta from zero to that moment when someone wrote us a big check.
And how long were you working on that before the sale?
About 12 and a half years. Yeah, so about 12 and a half, a little shy of 13 years. The growth path was interesting because it took us about 7 years to reach $10 million in revenue. And then it took us less than 4 more to reach $250 million in revenue.
That's crazy.
So it was a really asymmetric growth. And the driver of that acceleration was bringing in an outside investor to allow us to begin to acquire other companies, which is really the method that we're using with Rosemark to quickly build and scale the business.
Just going into that a little bit deeper, is there anything that really changed for you? Because obviously by then you were probably making a decent living already. So it wasn't like you're going from completely broke, though maybe at some point you were, because I know you also took out like a huge loan on your own personal name and stuff like that. But just, even that moment of relief, like were there things that really changed from that day onwards?
Yeah. So in the early days, you're hoping that you're making enough money to make payroll. And then a little bit later, you're making enough money at the end of the year to sweep the excess profit into your checking account, which is a great thing. And then by the time we reached the end, we were actually taking almost no money out of the company because we were actually leaving the capital in there to accelerate the growth. So it's kind of a strange curve where you're very lean, then you're experiencing some cash flow, then you lose that cash flow in the interest of putting the money into the company. But as we were reinvesting all of the proceeds of the profitability into the company, we knew we were building an asset of huge value at that point. And so it was easier to kind of suspend short-term cash needs for the hope and promise that the asset we were building would indeed have a liquidity event.
You can now look in hindsight and you can see that there was a huge inflection point where you were able to grow exponentially. I'm curious, would you change, if you were doing things differently, what would you do? Would you, for example, start from day one doing that? Or do you feel like you really needed those first 7 years or so to figure that part out?
Yeah, this is such a good question, Bilal, and it's something that I think about a lot because it's very relevant to what we're doing now. So I would say that it's very important, entrepreneurs talk about that moment of product market fit. And perhaps many of your listeners are familiar with the term, but just to quickly define it, it's that moment in which, as people affectionately like to say, the dogs are eating the dog food. Or more specifically, that you've designed something that fits a material economic need in the marketplace, that you can make that thing, product or service, and you can generate a profit. And so I would say that for entrepreneurs at any stage, this has got to be the key focus until you've got it. And I think today, because so many people are impatient and they've read the story of Facebook or perhaps even sort of know something about how Google or Amazon or Netflix were built, they sort of skip by the fact that all the hard work is really establishing product market fit. And I would say in the case of Rosetta, we established product market fit early, but had not really figured out how to industrialize or scale the business because it was a people-driven business. And what really scaled the business was to take that idea that was in product market fit and then acquire other companies and embed what we had established as product market fit inside the companies we acquired to make them grow faster. And that was really the aha. So just to return to your question, it's, don't run out and start acquiring companies till you're sure you have product market fit. When you do, you have a choice as to whether doing it organically or through acquisition. We chose acquisition. And this is perhaps relevant to what we're doing now because we're actually established product market fit with this technology we call quantitative personas. We know that works from our work at Rosetta, and we're using that as the basis now to acquire companies. So we're kind of skipping the first step that took 7 years at Rosetta and jumping right into the second step now.
So yeah, it sounds like just from my viewpoint, where I'm kind of studying a lot of companies and founders and seeing different approaches, this is an area that a lot of smart people that I respect say that is still underutilized, right? Because you see even in just my world of like internet specific companies, even bootstrap people who are self-funded, there's a huge growing area of micro private equity. And I'll have someone called Andrew Wilkinson on the show coming up soon, and Ryan Culp in the past, who's also talked about this topic. If you're interested, if someone's listening and wants to learn more, and it's people taking those principles from real private equity, if you want to call it that, and saying, well, we don't necessarily have to follow all of those rules. We can rewrite some of those rules and apply it to our area. So in their case, they might be acquiring companies that are doing $1 to $5 million in revenue or profits, and sometimes even smaller, like a few $100,000 in profit, but it's a revenue generating asset that can be bundled up or grown exponentially by adding a few different assets together. So we'll definitely go into some of those principles you've learned today, but really interesting to see that come up again and again, and as someone as experienced as you. One question I'd love to dig into is the breakdown of the deal, because there's you actually told me before we started recording that you were offered a higher amount of money, or a greater sum. So I think someone offered $600 million to acquire the company, and you chose the lower bid. So I'd love to understand, like, why is that? Because obviously that's still a significant amount of money.
Yeah. No, it's a question that I often ask myself now, many years later. So I think the sort of headline answer to the question is most deals fail. And so we really wanted to do a successful deal, and we felt that the culture and the business system and the people were ultimately more important than the headline price. And so Publicis offered us $575 million and a chance at an earnout that would have taken it to about $635 million. We failed on the earnout, and we failed early. The other deal was $600 million, no earnout, sort of cash on the barrelhead, as they say. And we just felt that the $600 million deal was with a company that we may not fit as well with. Now, unfortunately, over time, the Publicis deal did not work out, I think, the way they had wanted, nor we had wanted. But I would say for the first 3 or 4 years, it was quite successful. And I think the overarching sort of logic of our decision was intact. It was just that some unforeseeable things occurred that made it a little more challenging down the road, which really isn't relevant to your question. So I think as entrepreneurs think about selling their company, the first thing you want to think about is really, what is your objective? Is your objective just to maximize price and get out? Or is your objective to reward those who've come along and continue to build the business with your new partner? You end up with very different transaction structures and acquirers based on whether you're choosing option 1 or option 2. And we were really interested in continuing to build the business inside a larger institution like Publicis.
Just curious, like, how does a deal like that get structured? So let's say it gets sold for $575 million. By that point, you've got investors on the cap table, you've got employees who have equity and stuff like that, and then there's part of it is an earnout. So, like, in that sort of scenario, what can a founder realistically expect to take away from a scenario like that, and the other parties involved?
So it really does start with what is the fully diluted position of the founders and the employee base. And because we had used considerable amount of capital from our private equity firm, they owned a very large proportion of the company at that point. So they certainly took the largest chunk of value out, but they'd also put the largest chunk of capital in. And so I think this is one of the bigger challenges for entrepreneurs as they think about bringing on investors, as to basically what's the give for the get. What are they willing to take on from a dilution perspective to enable more growth? And is the pie growing bigger than their slice getting smaller as a proportion? I can tell you that when we brought private equity money in, they bought about 60% of our business. And when we sold the business, even though founders and management's position had been diluted down well below 40%, the 40% was worth 2 times what the 60% was worth at the time of the initial deal. And so this structure is exactly the same one we're using with Rosemark, where our intention is to find fast-growing businesses run by entrepreneurs who really want to continue to scale their business but need both strategy and capital to do so, and experience. And so our goal is for an entrepreneur to take cash off the table and then be able to have, as private equity people like to say, the second bite of the apple. And the second bite of the apple is when you get to sell the diluted version of the 40%. And if you do it right, that should be worth anywhere from 1.5 to 2 times what the 60% was worth. And so you end up being much, much better off. But this goes back to the way you asked the question, which is, what does the cap table look like? And in order for that to happen, you need to be able to grow the business very quickly while bringing the capital in. If you're not growing the business quickly, you shouldn't bring the capital in, because, of course, that's the whole reason to do it. And there's a way kind of mathematically to figure out how fast you have to grow the business in order to get something like a 2x yield from the 40%. And it's pretty hard to scale these businesses fast enough to beat the private equity invested path. It's not impossible, but it's pretty hard to do that because of and we were talking about this before we started the show, there's less operating leverage in a people-driven business as Rosetta was. And so with less operating leverage, there's less scalability. I mean, we scaled it dramatically, but, it went from, $50 million to $250 million with private equity money. A purely SaaS-based business can go from 50 million to 500 million or $1 billion in that same time frame. So it is all about scale, but the magnitude of the scale is very different between services and SaaS, of course. And therefore, I think services-based businesses that structure themselves correctly will probably do better in scaling and reaping the benefits with the strategic investor.
And I guess one other parallel I'll draw there is just a lot of the people I interview are kind of in the tech startup world or have been traditionally. And there's 2 normal approaches. One is you raise VC money, which is, I guess, a form of private equity, but a different style of private equity. It's normally like high growth, high return, and like 1 out of 10 might work and 90, whereas the private equity world often is your more established companies and what's kind of working and you're scaling, versus the bootstrap approach, which is you might still own 80% of the business, but it might never get to that scale that you've talked about. So I think that's definitely the nuanced answer in the details that people often don't get to hear about, because normally you read the headline, right? Someone sells a company for X amount of money. I'll just give one other example. I had Nigel Eccles on the show who started FanDuel. He sold the company for, I think, $600 million. At one point, it was worth over $1 billion. But he essentially made almost zero from that, from my understanding, because they'd raised a bunch of money. So his dilution. So that's just something that people don't always get to hear that. So I appreciate you being able to share your perspective and example for sure.
Yeah. And I'm happy to go into that in a little more detail. This is something that I talk about with my class. There was an amazing article in the Wall Street Journal a couple of years ago, and the headline was very clever. I can't remember the exact words, but basically it was all the unicorns founded by people who no longer have any money. The idea is that because whether it's private equity or venture, there's something called the waterfall, which is the structure in which money comes out at a liquidity event. And the very sharp tool that venture uses is something called a preference stack, where they get more than 1 times their money. So a preference of 1.5x or 2x or 3x, meaning that they're getting as much as 2 or 3 times the proportion of their money out before the founders do. And so several of these unicorns had brought in so much money with such a big preference stack that by the time the investors had been paid out 1x, 2x, 3x their money, there really wasn't any money left. Hence, they're at the bottom of the waterfall and there's no more water left coming down the waterfall. And so it's very important, going back to the first thing we talked about, that you're careful you're careful in choosing your investors. Then you're careful to bring in the right amount of money per unit of time. And then this relates back to this product market fit question, which is you better have product market fit before you're bringing money in, because if you don't, you're likely to be diluting yourself faster than you're creating value. And then the last sort of lesson, which I emphasize in my class, is that you want to make sure you have your growth hypothesis. So the first thing is your value hypothesis, which is product market fit. The second thing is your growth hypothesis, which is on what basis and at what rate will you grow value with respect to the money that's coming in. And if you don't have your growth hypothesis right, you can get washed out in just the way we've been talking about, where there's too much money coming in per unit of value created, and so the investors take the value and you don't. And so this is something we're very, very focused on at Rosemark with respect to our acquisition strategy, making sure we're buying very fast-growing companies whom we can help grow even faster, so their 40% becomes worth more than the 60%.
Yeah, and just the last thing I'll add is, I think for the listener is, when you read a headline, there's a lot more to the headline. And I think what you're explaining is what we all kind of need to learn if we haven't already, to be able to dissect that and truly understand. Because, of course, the headlines are there to get you to click most of the time. Before we go into like building the agency, the last question I have on the sale is, it still sounds like it was a successful deal for you and in a positive outcome, which is great. I had Jim McKilvey on the show, who's the co-founder of Square. And I asked him a similar question about the time where he became a billionaire and the things that I wouldn't have thought about, or a listener might not have thought about. And he said that he felt like he became a walking wallet. And he said, and in a negative way, because he said because people hear this headline or they know his actual net worth because it's a public company, and then he'll start getting invited to things. And he really wants to go, but he kind of has to temper those invites and say, oh, they're just asking me to come because they want my money for a donation, or they want me to invest in a company or something like that. I'm curious, did you have anything like that where you felt a change in the way people treated you?
Yeah, for sure. There was a lot written about our exit price, and which was certainly at a much lower scale than Square, but the same kind of thing. And I very early on decided to give quite a bit of the money away that I earned. It was actually one of the motivations, and it continues to be one of my motivations to basically make money, so that with that money I can invest in causes and ideas that I think will make the world better. One of the things that you discover when you end up making a lot of money is actually you need much less money than what you've just earned. And so, unless you use it for badge value and some number that makes you feel good, if you think about the good that you can do with the money that you've amassed, you very quickly begin to separate out what actually affects your lifestyle, which is a tiny proportion of the money you've gotten, and what can make the world better, which is most of the money that you've earned. And I think when you make that switch from this is about enhancing my lifestyle to making the world better, it rearranges the way you actually think about literally every dollar, whether it's the first dollar or the last dollar. And so I would say that's sort of for me, philosophically, the transformation. One very quick story. I was speaking with a nonprofit organization, and the executive director said, "So, Chris, how do we convince people to give us the money they would use to buy their Porsche?" And I said, "Nancy, that's the wrong question. The right question is, how do you convince them to give the money they would use to buy their second Porsche? And this is the whole point. So your first Porsche or your first whatever is a manifestation and celebration of the value you've created. But you only need one Porsche. You don't need two. And if you decide that you want to give the money away for your second Porsche, you've now made the transition from I made that money for self-aggrandizement versus I made that money for deployment for social good. And so this was about 15 years ago, and she still comes up to me and she says, I'm still looking for those people who don't want to buy the second Porsche.
No, that's a really great lesson. I think a lot of the time in nonprofits, especially, so I'd worked for a couple of years in nonprofits as well. And what I found is a lot of people, I don't want to generalize, but from my experience, a lot of people who are the ones asking for the money, sometimes they'll have this attitude of, well, they've got enough money already, they should be giving to this, this good cause that I'm telling them about. And of course, yeah, there's a part of it is that, but at the same time, that person has a right to do whatever they want with their money at the end of the day, whether that's giving 99% to charity or to invest it in their new company to go to space. It's up to them, like in my opinion. Yeah. So just moving on from here. So we talked a little bit about Rosetta. We're going to talk about the early years in a second. To kind of contextualize, you grew to $250 million in revenue, 1,200 employees. You obviously sold for a great amount of money. Let's go back to the earliest days because I think a lot of people listening to this are either at that stage or they're thinking about getting to that stage themselves. And I think nowadays we talk about services in such a negative way, especially in the software or the tech world, where we will talk about don't sell your time, create something that scales beyond your time. And I do agree with that overall, but people forget that an agency can be a great business, especially when you don't have much, especially when you need cash flow. And if you've got some skills that you can monetize, that might be the first place to start. So I'd love to go back to that beginning point and say, like, why did you start a business like that? And how did you get your first few customers originally?
So the sort of founding story behind Rosetta was that I had been running the Tylenol brand and before that the Band-Aid brand at Johnson & Johnson, and identified this problem that consumer market research at that time really was sort of stuck in the presentation deck. It was never really operationalized in the ongoing strategy of the business. And so that was that sort of crystallizing moment that said, gee, I wonder if there's a way to do segmentation that could be transported out of the deck and into the business. And so I took that theory and sold our first two clients during vacation days. I had left Johnson & Johnson by that point and was working in a consulting firm, and I was taking vacation days to go sell this idea. And I was selling it before we really knew how to deliver it. It was more of a theory. And so I sold $1 million worth of revenue before we actually opened Rosetta's doors. This was in the spring of 1998. And so with the confidence that we had $1 million in revenue and no people and actually no way to deliver it, I quit my job and said, let's go figure out how we're going to deliver this. And we built what was the sort of first piece of enabling software that would create the segmentations that we needed to actually drive into the business. And so we ended the first year with $1 million in revenue. We then had $3.5 million in the second year. We had $5 million in the third year. And back to the earlier part of the conversation, we very quickly established we had product market fit. We'd figured out a way to do segmentations that were not pieces of market research that gathered dust, or as some clients used to say, doorstops in their office, but rather a living, breathing way to operationalize a deeper understanding of consumers through segmentation. And so the business really took off pretty quickly, although it took us 7 years to get to $10 million. It took off pretty quickly, and we were serving only the largest and most sophisticated marketers. So they were referenceable to one another. One of the great books that I use in my course is called Crossing the Chasm by Jeffrey Moore. And Jeffrey Moore talks about the importance of a vertical focus and achieving product market fit with early adopters so that they're self-referential. And so we were going back to the brand managers that we used to work with and say, look, we've got a better way to solve this problem. We know you have because we had it a few months ago when we had your job. And then the great thing about product managers is they all sit in a single hall and they're somewhat competitive with one another like siblings are. And so we do a great job for brand A, and then brand B would say, what are you doing over there? And we then sell brand B and then brand C, and then brand A product manager would go move to another company and they'd bring us with them. And so we had this self-referential business based on segmentation that many people felt was really much more actionable and could make them do their jobs better. So that's really kind of how we went from about zero to, call it, $7 or $8 million. And then the next big jump was making an acquisition that more than doubled the business to 20 million.
So let's go into that $1 million amount a little bit more. So that's really amazing. And I guess you had the experience at a big brand to understand how that whole world works. You already had relationships, and selling from one brand to the next seems quite organic to someone like you who already knows it inside out. But for someone listening who doesn't really have an understanding of that world, like what does that $1 million of pre-sales kind of look like? Is that like one company who says, okay, we're going to work with you once you leave your job, we're going to invest $1 million for you to run this all for us? Or like, was that many brands in that $1 million amount?
Yeah, so it was two different companies, two different brands. One was Bristol Myers Squibb and one was Johnson & Johnson. And because we had been the client just a few months, or in some cases weeks earlier, we knew what the core problem was that they needed to solve. And so these were two businesses that were about ready to launch. And we knew that they didn't really understand their best customers as well as they might. And so we painted a picture of what would happen if you had a deeper level of the consumer, and then how you would launch the business differently. And so while $1 million or roughly $500,000 for each client seems like a lot of money, it was really, think of it as the scope on a very expensive gun. And so these brands were going to be spending scores of millions of dollars launching these businesses, and they spending $500,000 to understand the target consumer better, to make that marketing work better, was, if credible, a very, I guess no sale is easy, but it was a very reasonable or logical sale to make. That if you're launching a business, you're going to spend $30 million marketing it. Why not spend $500,000 with to generate a deeper understanding of the consumer that you can then use to operationalize that $20 or $30 million in marketing spend? And so a combination of being known by the people, having a credible idea on how to do that, and then the immediate application of that insight to making the marketing work better all kind of click together. And, inevitably a good amount of luck, right? I mean, any entrepreneur who doesn't bow at the temple of Lady Luck and say, oh my God, this never could have happened if I weren't really lucky. Better lucky than good, but best of all, to be both lucky and good. And I think we were both those things at that time.
And I guess just drawing from my experience with working with agencies, I technically have a small agency myself as in the digital marketing space. So listening to you talking about $500,000 a year contract for a company, I know from past experience with big companies that isn't a crazy amount of money. But for someone who's starting, let's say a digital marketing agency, paid social, SEO, something like that, where they might have learned some skills and then they're going to go and sell those skills to someone else, they're probably charging a few thousand to maybe tens of thousands a month versus $500,000 a year. Do you think from your experience, that's a huge miss? Like, should people really be looking at the agency world and saying, I want to be on the higher tier, and I need to figure out like what people are willing to spend that amount of money on versus like competing just on price and service at the lower end?
Yeah, so I don't know that there's a should to be here. I think there is a be deliberate in your choice. And so let me build on your either or for a moment. So, building social media programs or building a marketing program is really you are providing a service, right? And service-based solutions tend to be broken down into hours, and then hours are paid for at a rate, and there's a fairly narrow range of hourly rates for various activities. And those businesses are very difficult to scale because, the number of hours equals revenue, with the rate being the conversion point. Our approach at Rosetta was quite different. We went out to go solve the biggest problem. And the problem, the value of solving the problem was in tens or hundreds of millions of dollars. And so if you're solving a problem as opposed to providing a service, and the materiality of that problem is high, the economics begin to change. So let me illustrate with one of the most famous service businesses in the world, Mckinsey, right? So Mckinsey can put a 4-person team on a project for a month and charge $750,000 a month for 4 people. How can they possibly do that, right? I mean, the hourly rate is in the tens of thousands of dollars. The way they do that is they are working on problems and providing better solutions than anyone else. And so it's worth $750,000 a month. And that's how we were able, and just to sort of clarify, we sold each of those projects. They were 90 days long, and we made $500,000. So, and we made $500,000. McKinsey would have charged about $1.2 million for doing the same work. And so we used to like to say that we loved coming in after McKinsey because McKinsey would do it and it wasn't working at the time. McKinsey's a great firm and they do terrific work, but we were actually better at building segmentations than they were. And so they'd come in with a price umbrella of $1.5 million to $2 million, and we looked like a real deal at $500,000 or $600,000, and we got ours to work. So I think the distinction here is work for hire versus solving a material economic problem with a solution that actually can be measured, and then you can justify your higher price.
That's crazy. So yeah, it was 90 days, not a year, to clarify, or a few months. So I guess that brings up the question, looking at today, because obviously when you launched this originally, it was a different landscape. The media landscape was different. Where those companies were spending money was very different too. So if you're looking at 2021, let's say, and I know you are because that's what your current company is doing, if I was asking the question, what are those problems you're looking at in the world right now that people could be spending time and energy trying to figure out creative solutions for? Are there a few that stand out to you?
Yeah, well, there's sort of 1A and 1B that we're really focused on, which we think is really going to be the catalyst for the next generation of marketing solutions. And that is that, pulling lens back for a moment for context, when you look at all the marketing technology and data, it's been focused on what we like to say, optimizing the transaction. In other words, almost everything drives conversion. So the holy grail is, let me drive conversion from 3 basis points to 5 basis points of conversion. And indeed, increasing conversion by 2 or 3 or 4 or 10 basis points is worth tens of millions of dollars. There's a big problem though with the data, the technology, and the solutions that are focused on conversion. And that is they're missing the connection with the consumer. And so we think the next big problem is humanizing all of this mechanical digital technology so that you're deepening the relationship with the consumer as opposed to optimizing the transaction. Let me illustrate. You probably were online over the Thanksgiving weekend. You probably did a little shopping. You probably looked at a few things. And then through the miracles of cookies and remarketing, you then somehow got a barrage of either emails or if they got your email address, or you got a barrage of banner ads for the red shoes or the surfboard you were searching for. That is all about driving conversion. It has nothing to do with what makes Bilal think. What are the blood and guts of your preferences and your motivations? And so we believe the next big opportunity is to humanize, to use data and analytics and the mechanics, but to use those as a way to humanize the brand relationship as opposed to just drive conversion. We think that's the really big opportunity going forward. And then there are a whole series of subsidiary challenges, like how do you measure lifetime value? How do you track it over time? How do you convert an understanding of lifetime value to optimizing your marketing mix so that you're building deeper relationships with your most profitable customers? So, at the top of the mountain, the next mountain, we think is this conversion or this switch, I should say, from obsessing over transaction conversion to obsessing over brand connection. So
could you go into that a little bit deeper in terms of what is an example of, I completely understood the retargeting or remarketing example, but like for the brand to create that relationship or that map of what Bilal is as a user, is that what you mean? Like trying to extract those qualities from Bilal as an overall person? And how would you do that as someone who's working on
this? So this is exactly what our IP called Quantitative Personas do. So it turns out that every category, whether it's shoes or razor blades or cell phones, can actually be broken down into somewhere between 4 and 8 personas. And these aren't made up personas like Joe, he's 45 years old, he's a weekend warrior, and so on. These personas are derived from the data up. And they're built on what the underlying motivations and preferences of Bilal are versus those of Chris in a given category. We can map that within a sample, and then we can build an algorithm based on your transaction data to predict whether you're a Bilal or a Chris persona. And by being able to then score an entire database of customers and understanding their transactions and their profitability, we can then personalize your marketing experiences when you come to the site, or if you go to the store, or you go to the branch, or whatever it is, so that we've taken all the miracles of the data and the transactions and everything else and turned it into a much richer understanding of who you are versus who I am from a motivation and preference standpoint. And this is what we call bringing the humanity into the mechanics of digital marketing. And it's what we've built out and is really the basis of now building Rosemark.
Love that. So are there other areas that you considered going into that you haven't? Because when you were looking at taking the learnings from your first business, not being transactional, not being hourly focused and being more problem focused, taking that principle to what you're doing now, you've chosen this path. Were there like 2 or 3 other areas that you considered?
We talked a little bit earlier about the SaaS business model and the services business model. And I think there is tremendous opportunity for this next sort of wave of entrepreneurs to not rush to one side of the boat and say, I'm a SaaS business and I really don't want any services, or rush to the services side of the business and say, I don't understand or do technology, but rather creating the right blend. And so every single marketing problem has a technology and data aspect to it and a services aspect to it. And so I think those companies that blend these two solutions together in just the right mix will unleash enormous value creation. And so let me illustrate, one of the number one measures of the value of a SaaS business is their attrition rate. Basically, how after the 3-year subscription, how many people actually re-up for the next period of time for the subscription. The number one thing that drives retention rate is customer success. customer success is just a metaphor for the services that you're wrapping around a piece of technology, but somehow the private equity guys convince them not to call it services, they call it customer success because it sounds a little more product centered as opposed to service centered. So I really encourage your listeners to think about what's the right balance between technology and services. And obviously data is some of the glue that holds it together. And so I think each of these businesses is actually going to get reinvented to be a new blend of services and technology as opposed to the extremes on either side, which are just impractical.
Yeah, I think a lot of people I speak to have this vision of we're going to create this product and the whole world's going to love it, and we can just sit back and no one's going to have to service them, or even hiring salespeople, which is another part of the business which really works well. Like there are plenty of companies that prove that. I'm curious, when you're looking at the landscape, and you also lecture at Princeton, and you're studying businesses for a living, basically. So I'm curious, like, are there players in the SaaS space that you look at that you think are doing a good job of this? Like, and just one comes to mind to me is Salesforce. Of course, is this giant where everyone I know who's used Salesforce doesn't love Salesforce. But for some reason, they're all still using Salesforce. So like, they're definitely doing something right, of course. So I'm curious, like, are there a few examples that you look to that are doing this pretty well?
Yeah, well, I'm just pausing on Salesforce for a moment. They have done, in a very clever way, a little bit of what we were just talking about this balance between SaaS and services. So what they've built, as we all know, is an ecosystem of service providers. And so what makes Salesforce work is that it's a very good, in many cases, piece of software to solve a specific marketing problem. They stay pure to we're a technology company. And then they've incubated and cultivated this incredible ecosystem of service providers, whether they're systems integrators to implement it or whether they're service companies to get it to work and so on. So I think there are sort of business systems beyond a company. There are business systems that actually are doing what we're talking about here, of striking the balance between services and sales. But back more to the point of your question, there are still very significant unmet needs or material economic problems in the areas of, for instance, consumer data platforms, CDPs. So about a year and a half ago, the CDP was going to be the next, panacea. And because we must develop a singular view of the consumer, understand all of her transactions, her channel preference, her revenue, her cost of acquisition, and so on. The CDP thing really has not been cracked yet. And there are some companies that have made pretty good progress. But frankly, all of this is dependent on a single view of the consumer. And so whether you do that as a software solution and you sell it as a sort of single tenant, multi-tenant approach, so you have the same software that's running everywhere, or whether you do it as a services business that actually builds it on a bespoke basis, it's unbelievably important to get to solve this problem. And I think entrepreneurs who are focused on unifying the data and authenticating at the individual level will do very well, whether they end up being at one end of the blend or the other. And there are some companies that have made some real progress there. I think there are other types of solutions in personalization that are also making progress. There's a company that Salesforce actually just bought that we got to know pretty well called Evergage, headquartered just outside of Boston. They do a terrific job on personalization. There's a company called Rich Relevance, which is also doing a great job on personalization. And so I think there will be a small number of small companies that actually really get into this high impact role. But I think they're going to have to be part of larger companies, whether that's like Evergage being acquired by Salesforce, or some of these other companies that we're looking at to try to pull together into a critical mass that'll win the game.
The last couple of points on that growth curve for you was one of the biggest parts to growing a company at that scale is hiring good people, or arguably any company, one of the most important.
It's the only
thing. Okay, yeah. But you hired 1,200 people plus in the time that you were there, or your organization had that many people. So I'm curious, like, what was your method and lessons learned from hiring and then also firing people as well, because that's also a part of the process?
This is actually one of my favorite topics, and something that I spent, particularly toward the end, almost all my time on, was the people part of it. So a couple of sort of lessons learned. First, always overhire for the job. So, if you're looking for somebody who's at level one does the job, hire someone who's level 8. And just the right people will be attracted to you and your vision and are willing to do level 1 jobs, even though they're level 8 people. And so if there's one thing, there are probably half a dozen things that really worked on attracting the best and the brightest of our industry into Rosetta for a period of time. But the number one thing was way overhire for the job. The second sort of basic principle is alignment on motivation. So one of the core pieces of DNA of the Rosetta culture and the people we hired was not only were they the best of their peer group, but they were really kind and generous and empathic and did not have sharp elbows. So being able to build a culture of cohesion with a group of real experts is tricky, but when you get it right, it's magic. And so sort of putting 1 and 2 together, it's attracting a team where the client kind of wishes they worked for you as opposed to their client organization. And in fact, we hired a number of people from our clients because they had decided they'd rather work with us. And clients who stayed clients all said, boy, your people are unbelievable. They are, the best that we've ever worked with. When we were talking to an accounting firm, we were hiring our first accounting firm, and the accounting firm came in and looked at our books and they said, God, you're a $5 million business and you're running this like it's a $1 billion business. We've never seen anything like this. And we said, well, how are we going to become a $1 billion business if we don't start running it that way now? So I think, running your business and planning your business for big scale success, which is really just the other side of the coin of overhiring the talent, is incredibly important.
Just love to ask one follow-up question to that part, because I loved your point about always overhire, but I guess the flip side to that is you might hire too many people who are essentially overqualified in inverted commas for the role, and they might become like demotivated quite early on because they're doing something that is kind of beyond what they should be doing in a way.
So when you think about what's the motivation of someone to take a job that is beneath her or beneath him, first, that person really has to believe where you're taking the company and the fact that it's not going to be below her or him for very long, that she is very motivated to take what she's really good at and make this job as big as she possibly can, but she makes the job really big by being successful. And so here's a real live example. One of Rosetta's key leaders and someone who's still a very, very close friend, his name is Hari Mahadevan. He walked away from being promoted to being a partner at Mckinsey to come join Rosetta when it was $5 million. And we had 1 or 2 healthcare clients. And he built a $70 million healthcare vertical. And so he walked away from a huge job for the possibility of taking everything he was really good at and building a gigantic business. I mean, he built a business that was probably bigger than some McKinsey offices, and he did it himself with his team, of course, through his team, because he had the right skills and magic and motivation And he was way overqualified for the job, but he saw something that he believed he could take his skills and his leadership and his inspiration and our idea and really make it go.
That's a great example of finding something that someone might be seeking in their career, and you were giving him value, right? You were giving him ownership and something that he might not get at McKinsey, and the feeling of building something almost not from scratch, but like quite a small level for what he's used to, and really making it his own. And I think that's a lot of the time when you're a smaller company, that's the sort of stuff that you're going to be able to offer that a big company can't. And I've done the same. I went from Google to a non-profit that was 100 people. And the main driver for me, one was to do some good in the world, but also like it was the role itself. It was the ownership. It was the fact that I could learn new skills, extend my learning curve, all those sorts of things. And I think a lot of people, when you're smaller, you don't realize you have a lot to offer if you can give the right incentives for those people to grow. And you also have to reward those people in ways that you can't do if you're not a Google or a McKinsey, right? So
yeah, no, you said it better than I did, Bilal. I mean, give them the opportunity, give them the ownership, give them the resources, which are small at the beginning. And I think there are few for builders, people who like building businesses or parts of businesses, there are few rewards greater than the opportunity to apply your creativity and leadership to build something from nothing.
I've heard a few people say this recently, that you should hire slow and fire fast. And one of the biggest lessons they've learned in hitting certain milestones is they should have probably fired someone earlier when they had a gut feeling that it wasn't working out, and that person might have, caused more issues or hurt the culture of the company and that sort of stuff. So I'm curious from your point of view, like what was your experience having to let go of people?
I love that phrase, hire slow, fire fast. I think that's exactly true. And I think often most times, if you've done the right professional development and communication, the person being fired is not surprised, and in many cases is relieved because they know, she or he knows, it's not working out. And so I think, sort of rule number one of good firing, if you can say it that way, is good professional development. Lots of communication, clear expectations, clarity around role, responsibility, deliverables. And so it becomes, it's never sort of empirical. I don't want to make it sound surgical because it's a very, very gut-wrenching thing to do, to tell someone that it's not working anymore or it's not working at all. Perhaps it never was working. But it's also there's a form of grace in this if you do it correctly, because it's not about the person, it's about the fit between the task, the need, the responsibility. And so in the times that I've had to fire particularly senior people, I then take on the responsibility to help them get on to their next job. And in fact, I've helped many of the people whom I had to let go get a series of jobs. So, I consider it it's a decision about the fit. It's not a decision about the person. And as the employer, as the boss, you have an added responsibility to those people you fire to help them, land on their feet, for them to maintain their confidence, and to move on to the next thing. And, hopefully they get onto a job that it works better for them. So I think there's a lot of responsibility that goes into firing someone. It's not just saying it's time to go, but it's time to go, and here's why and how, and let's work together to get you to the next place.
Thanks for going through all of your experience there. I know there's a lot of lessons learned. You kind of invented the equivalent of what a lot of people have heard of, like Myers-Briggs or something like that. And my understanding is you had a version of that, or something similar that people were using as part of that business. And you've written a whole book on this sort of stuff as well. So I've heard you talk about different personality types for builders. and there were four that I'll just call out here. One is the driver, one's the explorer, the crusader, and the captain. And you've talked about when you're building a team, one, you need to know which one you are or what the culture of the company is going to be. And then secondly, like when you're building a team, you need to try to find the different pieces that will complement your work. So first of all, did I understand that correctly?
Yeah, very. You did the great Cliff Notes version of the whole book in 4 sentences. Well done.
There we go. So, and I think to make this more tangible, I'd love to just go through each one with an example. So you talked about Apple being the driver, and you talked about a relentless person. They're commercially focused. They're confident. The explorer is like a Facebook. They're curious. They're system-centric, dispassionate. The crusader is Google, audacious, mission-inspired, compassionate as well. And the captain, HP, which is pragmatic, team-enabling, and direct. I know if you're listening to this, that was a lot in one go, but we'll go through each one in a second. So maybe we just start with Apple, someone who is relentless, commercially focused, and confident. Why would Apple be a great example of the driver?
The personality structure is at the person level rather than at the company level, although companies founded by big personalities, as each of those companies were, often the company culture starts to take on some aspects of the founder. But as we know from the book and the movie and all the articles written about Steve Jobs, his genius was his intuitive ability to discover consumer opportunities or problems before the consumer even knew about them. I mean, we didn't know we should be carrying around a piece of plastic in our pocket that played music and ultimately connected us to the world. So he had this genius of product market fit. And he heard and saw things that nobody else saw. And I think that it seems to have built up, I didn't know Steve Jobs, but it seemed to have built up a high level of confidence and a level of sort of impatience and abrasiveness when other people didn't see it. He just saw things that nobody else saw and expected them to fall into line and to execute his vision. And he was relentless if they didn't. For better and for worse, I am the driver myself. I unfortunately haven't seen anything quite as genius as what Jobs saw, but I have a lot of sympathy for the idea that when you see something and you know how to commercialize it, there is a level of both excitement and almost intoxication of getting at it on the one hand, and then there are very high expectations and high level of drive to the team around you. And so this can attract people who are equally driven, but it can also burn a lot of people out because your patience starts to wear thin quickly if people aren't getting it. And so you have high expectations and you can burn through a lot of people. In Apple's case, and specifically Steve Jobs, he was able to use the vision to draw just enormous talent toward him. Look what happened, and look what continues to happen. I think the measure of the fact that he institutionalized this exacting expectation is that his successor has done such a great job, and by some standards, maybe even better job than he did. I think that he was successful in moving from the strengths and idiosyncrasies of his own personality into institutionalizing within a company, which is now, we know the rest of the story.
Just to wrap up, we've got Facebook as the explorer. What makes, I guess you're talking about Mark Zuckerberg in this case.
Yeah, so the interesting thing about the explorer is that they see a system at play everywhere. And so the genius of Zuckerberg was that he saw this kind of underlying, but yet at the time unrealized concept of a way to network people through pictures and through stories and through posts. And so he saw an unmet need, and he saw almost like a natural law system at play that he could tap into and exploit. I think Zuckerberg is a great example of the explorer mindset. I think that Drew Houston of Dropbox is also. He saw a systematic problem with cloud storage and built a system to solve that problem, and has created a business worth well over $10 billion.
Yeah.
So these people are really drawn by their curiosity and the nature of the problem itself.
And then just the last one's Google as the Crusader. I love that one. So, audacious, mission-inspired, compassionate. People might debate that last one nowadays, but curious on your take.
Well, certainly the do no evil mantra of Google in the early days, I think, is reflective of this. The solution that really unleashed the power of the internet, the search algorithm, really changed everything in the world in many regards. And so the vision and the mission to actually be able to then turn that into a company and just a phenomenon is the nature of the explorer. The explorer looks to solve game-changing, world-changing problems, and does so by inspiring others who share that mission to come join.
Got it.
The captain is really different because the captain is less interested, so reviewing, if it's about the problem for the driver, if it's about the system for the explorer, it's about the mission for the crusader. The captain is all about the team. In fact, the nature, I'm exaggerating a little bit here, but what the business is less important. It's really about unleashing the underlying productivity of the person. How can I help people become productive members of a team? While we talk about HP, perhaps an even better example is Jack Ma. And, he brought 16 of his friends together in an apartment in China and created Alibaba. And not only that, Alibaba is sort of like a captain's business model because it was unleashing the commercial potential of many, many, many small merchants around the world through the Alibaba platform.
When building teams, how important is it to have all four of these players within your team?
I think you don't need all four of them. You definitely need at least two of them. And based on who the founder is, you need what we call the polar complement. Polar as in like the opposite pole of complement, meaning that what her strengths are, the other person's weaknesses are, and vice versa. And so we see kind of a natural pairing here where the driver and the crusader come together. The crusader gets the mission and the humanity of it. The driver gets the product and the market part of it. The explorer and the captain pair together as good complements because the explorer is focused on the system and the captain is focused on the team. So, large companies should certainly have lots of all of these people. But if you're a small team, we encourage you to pair up with your polar complement, because in so doing, you'll actually be able to handle more of the diversity of problems that beset a entrepreneurial venture.
Love it, man. Well, thank you. I know we tried to summarize the whole book in 5 minutes, but we'll wrap it up here. But we'd love to have you on again soon, and we can spend another 2 hours talking all about new stuff that you're working on.
Thank you, Bilal. It's been a pleasure being on your show. I really appreciate it. Just one other quick footnote. For your listeners who want to figure out which builder personality they are, they can go to www.buildforgrowth.com and actually take a very short quiz and figure out which builder type they are, and then a lot of information about who you might want to team up with if you're building a new team. So we'd encourage anyone to go ahead and do that. And obviously it's free. It's just out on the internet. So thanks for the opportunity to talk about this whole range of stuff. And I would love to come back in a couple of years or maybe sooner and tell you how things are going at Rosemark.